The early 2000s, a time of unprecedented economic optimism. Low interest rates fueled a wave of borrowing and spending, but beneath the surface, a storm was brewing. A dangerous combination of factors was aligning, setting the stage for a financial earthquake. It all started with a seemingly harmless concept: the American dream of homeownership. Our journey begins in the heart of the financial system. Deregulation in the financial industry had created a breeding ground for risky lending practices. Banks, flush with cash, lowered their lending standards to attract more borrowers. This led to a surge in subprime mortgages, loans given to borrowers with poor credit histories. The dawn of the new millennium saw the United States basking in economic prosperity. The stock market, after a brief stumble, resumed its upward climb. Low interest rates acted as fuel on an already roaring fire. Borrowing became incredibly cheap, encouraging businesses to expand and consumers to spend. The American dream, it seemed, was within everyone's grasp, but this demand was built on shaky foundations, propped up by risky lending practices. The Federal Reserve, under Alan Greenspan, adopted a policy of low interest rates. This accommodative monetary policy flooded the financial system with cheap credit. Banks, awash in liquidity, were eager to lend, often with little regard for the creditworthiness of borrowers. Mortgage lenders loosened their underwriting standards, offering loans with low introductory rates and minimal documentation. The flood of cheap credit fueled an unprecedented housing boom, pushing prices to unsustainable levels. What began as a seemingly virtuous cycle was morphing into a dangerous bubble. Deregulation swept through Wall Street, dismantling safeguards. The Gramm-Leach-Bliley Act of 1999 repealed key provisions of the Glass-Steagall Act. Deregulation, coupled with the rise of complex financial instruments, created an environment ripe for excessive risk-taking. Wall Street played a central role in inflating the housing bubble. The securitization of mortgages became the engine of Wall Street's profit machine. These mortgage-backed securities were highly rated by credit rating agencies. Investment banks created ever more complex securities known as collateralized debt obligations, or CDOs. The crisis quickly morphed into a global contagion. Financial institutions around the world had invested heavily in American mortgage-backed securities. Leverage magnified the impact of the housing bubble's burst. The interconnectedness of the global financial system meant that a crisis in one part of the world could quickly spread to others. The American dream took on a turbocharged quality, fueled by low interest rates and deregulation. The housing market entered a period of unprecedented growth. Prices climbed at a dizzying pace, far outstripping wage growth and inflation. Speculation became rampant, with investors piling into the market. Subprime mortgages proliferated at an alarming rate. Lenders relaxed their underwriting standards, offering loans with little or no down payment. The logic behind these loans was deceptively simple. This assumption proved disastrously wrong when the bubble burst. Wall Street played a pivotal role in transforming the subprime mortgage market. Investment banks developed innovative ways to package and sell these risky mortgages. The process, known as securitization, involved bundling together thousands of individual mortgages. The intricate web of interconnectedness designed to spread risk instead amplified it. By the mid-2000s, the housing market had reached a fever pitch. Prices had risen to unsustainable levels, driven by speculation and easy credit. Mortgage defaults began to tick upward. The housing bubble, inflated to its breaking point, was about to burst. Wall Street saw an opportunity in the burgeoning market of subprime mortgages. They took thousands of individual mortgages, bundled them together, and issued bonds backed by the cash flow from those mortgages. This securitization process was built on a flawed premise that housing prices would continue to rise indefinitely. But what happened when the music stopped? Not content with the complexity of simple mortgage-backed securities, Wall Street's financial wizards concocted even more intricate and opaque instruments, collateralized debt obligations, or CDOs. If MBS were a smoothie blended from different mortgages, CDOs were a multi-layered cake, each layer composed of different slices of MBS, some riskier than others. Imagine taking those tranches of MBS, the AAA, the BBB, even the riskiest ones, and bundling them together into a new pool. Then slice and dice this pool into new tranches, once again rated based on their perceived risk. The safest tranche of a CDO, often misleadingly labeled as AAA, might contain a mix of AAA and BBB tranches from the underlying MBS. Why would anyone do this? Because it allowed Wall Street to further obscure the true risk embedded in these securities. By mixing riskier assets with safer ones, they could create a tranche that appeared safer than it actually was, at least on paper. And as long as investors kept buying, the profits kept flowing. These CDOs, along with other complex derivatives linked to mortgages, spread throughout the financial system like wildfire. Banks, hedge funds, insurance companies, even pension funds, all were lured by the promise of higher returns, often with little understanding of the underlying risks. In this alchemical transformation of mortgages into complex securities, the credit rating agencies played a crucial and ultimately disastrous role. These agencies, tasked with assessing the creditworthiness of borrowers and the riskiness of investments, were supposed to be the gatekeepers, providing investors with independent and objective assessments. But the rating agencies, driven by their own profit motives and a desire to maintain market share, failed spectacularly. They gave their seals of approval, often the coveted AAA rating, to securities backed by subprime mortgages that were essentially ticking time bombs. How could this happen? The agencies relied heavily on mathematical models that failed to account for the real-world complexities of the housing market. They assumed that housing prices would continue to rise, that defaults would remain low, and that the correlation between different geographical areas was minimal. These assumptions proved disastrously wrong. When the housing bubble burst, the models crumbled, and the ratings proved worthless. The agencies, once seen as guardians of financial stability, became unwitting accomplices in a system rigged for disaster. The global financial system, in the years leading up to the crisis, had become a house of cards built on a foundation of trust. Investors trusted the rating agencies trusted the mathematical models, and everyone trusted that housing prices would continue to rise. This trust, however, was misplaced. The models were flawed, the ratings were unreliable, and the housing market, as we know, was headed for a devastating crash. When the first cracks appeared in the foundation, the entire edifice began to crumble. The collapse of the housing bubble exposed the dangers of excessive leverage, the perils of complex financial engineering, and the systemic failures of regulation and oversight. It was a stark reminder that even the most sophisticated financial systems are vulnerable to human greed, flawed assumptions, and a dangerous disregard for risk. By 2006, the seemingly invincible housing market began to show cracks in its foundation. After years of relentless growth, home prices plateaued and in some areas even dipped slightly. While this might have seemed like a healthy correction to some, it was a troubling sign for a market built on the assumption of perpetual appreciation. The adjustable-rate mortgages, those ticking time bombs lurking beneath the surface, began to explode. As interest rates rose from their historic lows, monthly payments for millions of homeowners ballooned, becoming unaffordable burdens. The problem was particularly acute in the subprime market, where borrowers with poor credit and low incomes had been lured into loans they could ill afford, often with teaser rates that reset to much higher levels after a year or two. As these adjustable rates reset, defaults surged, sending shockwaves through the financial system. Yet, despite these alarming signs, many remained blind to the looming crisis. Wall Street continued to churn out mortgage-backed securities, rating agencies continued to bestow their blessings, and investors continued to gobble them up, driven by a toxic mix of greed and a belief that the party could go on forever. Early warning signs, voices in the wilderness. While many remained oblivious to the gathering storm, some voices in the wilderness tried to raise the alarm. Economists, analysts, and even some within the financial industry itself pointed to the unsustainable rise in housing prices, the proliferation of risky lending practices, and the dangerous levels of leverage in the system. One such voice was that of Raghuram Rajan, then the chief economist of the International Monetary Fund. In 2005, at a prestigious gathering of central bankers and economists, Rajan delivered a paper titled, "Has Financial Development Made the World Riskier?" His answer, in short, was a resounding yes. Rajan warned that the complex web of financial interconnections, while seemingly spreading risk, had actually increased the potential for a catastrophic meltdown. He argued that financial innovation, while often touted as a force for good, had created new and poorly understood risks that could amplify shocks to the system. His warnings, however, were largely ignored. Some dismissed him as a Cassandra, a lone voice of doom in a sea of optimism. Others argued that the system was robust enough to handle any bumps in the road. The prevailing sentiment was that the music would keep playing, the profits would keep flowing, and anyone who dared to suggest otherwise was simply out of touch. Default surge, denial, lingers. As 2006 progressed, the warning signs grew louder and more difficult to ignore. Mortgage defaults, particularly among subprime borrowers, continued to climb at an alarming rate. Foreclosures, once a relatively rare occurrence, became increasingly common, spreading like a virus through neighborhoods across the country. The epicenter of the crisis was the subprime mortgage market, where loose lending standards and exotic loan products had enabled millions of Americans to purchase homes they could not afford. As interest rates reset and home prices stagnated, these borrowers found themselves trapped in a financial nightmare, unable to make their payments and facing the prospect of losing their homes. Yet even as the crisis deepened, many in positions of power continued to deny its severity. Wall Street executives, their bonuses riding on the continued flow of mortgage-backed securities, downplayed the risks, arguing that the problems were contained to a small segment of the market. This denial, however, was becoming increasingly untenable. The cracks in the foundation were widening, threatening to bring the entire financial system crashing down. The epicenter of the storm. Certain regions of the United States felt the tremors of the impending financial earthquake earlier and more acutely than others. States like California, Florida, Nevada, and Arizona, which had experienced the most rapid and unsustainable price appreciation during the boom, became the epicenters of the bust. In these areas, fueled by a heady mix of speculation and easy credit, home prices had soared to dizzying heights, far outpacing income growth and fundamental economic indicators. Flippers, speculators, and even ordinary families had been caught up in the frenzy, taking on massive amounts of debt in the belief that prices would continue to rise indefinitely. When the bubble burst, the consequences were swift and brutal. Home values plummeted, leaving millions of homeowners underwater, owing more on their mortgages than their homes were worth. Foreclosures skyrocketed, neighborhoods were decimated, and the once thriving construction industry ground to a halt. The pain, however, was not confined to these hard-hit regions. The crisis, like a contagion, spread through the interconnected arteries of the global financial system, infecting institutions and investors around the world. The stage was set for a financial meltdown of unprecedented scale and severity. The storm breaks. The year 2006 marked the beginning of the end of the illusory prosperity that had defined the early 2000s. The cracks in the foundation of the financial system, once barely noticeable, had widened into gaping chasms, threatening to swallow the entire edifice. The warning signs, ignored for so long, could no longer be denied. The storm was upon us. In part 2 of this series, we'll witness the full fury of the financial crisis as it unfolds. We'll delve into the collapse of Lehman Brothers, a pivotal moment that sent shockwaves through the global economy. We'll explore the government bailouts, the desperate attempts to stave off a complete meltdown. The human toll of this crisis was immense, leaving millions unemployed, losing their homes, and seeing their dreams shattered. We'll examine the lasting impact of the crisis, from increased regulation to a fundamental shift in the public's trust in the financial system. The global financial crisis was a watershed moment, a stark reminder of the interconnectedness of our world and the devastating consequences of unchecked greed and systemic failures. Join us as we continue our exploration of this pivotal chapter in economic history. Don't miss Part 2, The Collapse.